All right, let's say you find a perfect property. One investor pays cash for it. The other investor uses a loan. Which investor actually makes more money? Let's break it down. All right, so in most scenarios, people think that the cash buyer is always going to have the upper edge, that because they have no debt, that there's less risk involved, they're technically going to make more profit. But that's not always the case. If you really break it down and look closely, you're going to find that oftentimes, especially with commercial real estate, that when they have a loan incorporated in the deal, oftentimes they are going to be able to make more profit. Let's break it down. All right, so let's say the property is a 6% cap rate. With that being said, if you pay cash, that means you're technically getting a 6% return on your investment, which is pretty cool. But what if you were to use financing? What if you went to the bank and you got a 5% interest rate on your loan? You would technically be borrowing money cheaper than the return that this property is offering, which is pretty cool. That right there is called positive leverage, and that could actually boost your returns. Super awesome. On the other hand, let's play devil's advocate here. Let's say you went to the bank and you got a 7% interest rate instead, so it's a little bit higher. You're only getting 6% return on the property itself. That's called negative leverage. In that specific scenario, the cash investor actually wins. All right, so understand this. When it comes to winning in real estate, it's not a one-size-fits-all where cash is always the winner or financing is always the winner. It's more so along the lines of which equation will help you win this exact deal. So you definitely want to keep that in mind, because in some cases, financing is the winner. All right, so if you need help reviewing a deal, reach out to me. I'd be happy to crunch the numbers with you.